Welcome new viewers, returning subscribers, thank you. We aim to provide you with invaluable content to your satisfaction. Let us now prepare you to pass the Securities Industry Essential, or SIE exam. The SIE exam is a great way to start your career in the financial investments sector. It covers the basics of the industry and prepares you for more advanced exams. We offer a special series of knowledge to help you ace the SIE exam. Don't miss this chance to get ahead in the financial market. Subscribe now and join us on this exciting journey, and while you're at it, like the video too. Thanks, let us begin. The process of matching investors who have money with issuers that need money is one of the primary purposes of the securities industry. Ultimately, the securities marketplaces and its participants provide the bridge between those with capital or money to invest and those that need the capital for financing purposes. What's an issuer? An issuer is defined as a legal entity that sells securities in order to finance its operations. Issuers include businesses that need capital to grow and prosper, as well as governments that typically borrow funds as a means of paying their bills or building infrastructure. Issuers include, but are not limited to, the U.S. Treasury and various U.S. government agencies, foreign governments, state and local governments, corporations, and banks. There are two primary methods that issuers use to raise capital: issuing debt securities or bonds, and issuing equity securities or stocks. Debt securities. Both corporations and various government borrowers raise funds through the issuance of publicly traded loans, which are referred to as bonds, notes, or debt instruments. A bond is a security that represents the amount of indebtedness or principal that the issuer owes to the investor. Investors who purchase bonds are considered creditors of the issuer and essentially lend their funds to the issuer for a specified period, until maturity. The issuer is required to repay the principal balance of the bond at a future date and will typically make interest payments over the life of the loan. If the issuer misses an interest or principal payment, it's considered to be in default. Equity securities. Traditionally, corporations raise capital through the issuance of stock, or equity. If an investor purchases the stock, she has an ownership interest in the underlying business, and if the company is profitable, may be entitled to a portion of the profits through a dividend distribution. The ownership interest typically doesn't have a maturity date, and the payment of any dividends is voluntary for the issuer. Both stocks and bonds will be covered in greater detail later in this manual. Financial firms are the bridges that connect issuers and investors. These firms generally fall into one of two broad categories: broker-dealers or investment advisors. What's a broker-dealer? The term broker-dealer refers to the two capacities in which a firm may operate. A broker is defined as any person who engages in the business of effecting agency transactions in securities for the account of others. Essentially, brokers match up buyers and sellers and earn a commission for their efforts. As a comparison, think of how a real estate agent is employed by a real estate broker and acts on behalf of customers to earn commissions. A dealer is defined as any person who engages in the business of buying and selling securities for its own account. Firms acting as dealers engage in principal transactions in which they buy securities directly from their clients and hold them in inventory, or they sell securities to clients from their inventory. For executing these trades, dealers are entitled to either a markup or markdown. Now, consider the similarity to a car dealer that buys for or sells from its inventory, and will either mark down the car cost when buying or mark up the car cost when selling. Since firms are continuously executing trades as either a broker or a dealer, it's convenient to simply refer to them as broker-dealers, broker-dealer departments. Many brokerage firms or broker-dealers are divided into several distinct departments. Investment banking, or IB. Investment banking is the area that works directly with the issuers to arrange and structure their securities offerings. For example, this department may advise an issuer who intends to raise funds through the issuance of stocks, bonds, or a combination of both. Remember, investment bankers are often referred to as the underwriters of securities. IB may also assist companies that seek to merge with or acquire other companies, or M&A, or those that need to restructure due to bankruptcy. Research. The analysts in a firm's research department study both the markets and individual issuers in order to issue recommendations. The typical recommendations are to buy, sell, or hold. Sales. Financial professionals who work in the sales area typically market individual stocks or bonds, but also packaged products like mutual funds to both retail investors and institutions. Historically, sales personnel have been referred to as stock or bond brokers. These salespersons are also referred to as registered representatives, or RRs, or investment advisor representatives, or IARs. Trading. Trading professionals handle the execution of trades for both the firm's clients and the firm's own or proprietary account. These trades may occur either in electronic marketplaces, such as NASDAQ, or hybrid marketplaces, such as the New York Stock Exchange or NYSE. Operations. The operations area ensures that all of the paperwork, funds, and securities transfers that are associated with a trade or processing are handled efficiently and according to specific industry standards. Operations personnel perform functions such as generating customer statements, confirmations, and tax records, as well as assisting in the transfer of securities and/or funds. This personnel are also responsible for ensuring that all firm and client assets are organized properly and safeguarded. What's a market maker? When a broker-dealer chooses to display quotes in a trading system to indicate its readiness to buy and/or sell securities at specific prices, the firm is referred to as a market maker. In most cases, a market maker is required to make regular bids and offers and meet specific capital requirements. A market maker's quote is two-sided since it indicates the price at which it's willing to buy a security from, bid, or sell a security to, offer, other market participants. For example, a $10.01 price the firm will buy, a $10.06 price the firm will sell. Ask size. In the example, the firm is willing to buy 1,000 shares, 10 round lots of 100 shares, at $10.01 and/or sell 2,000 shares, 20 round lots of 100 shares, at $10.06. Generally, if no size is indicated, a market maker must be prepared to buy or sell a minimum unit of trading, 100 shares, at the quoted prices. What's a trader? Other firms and individuals that simply choose to trade securities for the firm's benefit, proprietary trading, or for the benefit of the firm's clients without the interest in making markets, are referred to as traders. These traders are under no obligation to enter quotes into a marketplace. Instead, they execute trades against the quotes of market-making firms. What's an investment advisor? Many financial firms act as investment advisors rather than functioning as broker-dealers. So what's the difference between a broker-dealer and an investment advisor? Essentially, it comes down to how each is compensated for the services it provides. Broker-dealers earn compensation, for example, commissions, for executing transactions, while investment advisors charge fees for providing advice to their clients. These fees are often based on a percentage of assets under management, AUM, and are charged regardless of whether any trades occurred in their clients' accounts. Investment advisors come in all shapes and sizes. Some manage hundreds of millions of dollars for mutual funds, while others have small practices and work exclusively with individual investors. What is a municipal advisor? A municipal advisor is a specialized type of advisor that provides advice either to or on behalf of a municipal entity, such as a state, county, or city. An advisor's client is typically the issuer, not the investor. These financial professionals provide advice related to the structure, timing, and terms of a municipal finance offering. The municipal advisor definition is broad and includes financial advisors, third-party marketers, placement agents, solicitors, finders, and swap advisors who engage in municipal advisory activities. For example, let's assume that a town intends to issue bonds to raise funds for the construction of a new gymnasium. If the mayor and members of the town council lack the necessary financial or securities knowledge, they may hire a municipal advisor to act as an intermediary between the town and the underwriter. Types of investors. As mentioned earlier, broker-dealers connect issuers and investors in primary offerings, but are also involved in the trading of the issued securities. Investment advisors also often assist investors in building a balanced portfolio through a process that's referred to as asset allocation. Now let's examine some of the different types of investors. Retail investors. Many investors who directly buy stocks or bonds from broker-dealers are retail investors. Essentially, this term means regular individuals who have limited assets and income. These investors may hold assets in one person's name, a single account, or perhaps together with their spouse or a friend, a joint account. Other forms of retail ownership include various retirement accounts, such as IRAs, or custodial accounts that are established for children. The primary focus of securities regulation is on protecting these retail investors. Many professionals define a retail investor as a person who doesn't meet the definition of an institutional investor. Accredited investors. The Securities and Exchange Commission, the primary regulator for the securities industry, categorizes certain investors who, by the nature of their income or assets, are viewed as more sophisticated and/or able to assume greater risk. These investors are referred to as accredited investors and include the following: financial institutions, for example banks, large tax-exempt pension plans, and private business development companies, directors, executive officers, or general partners of the issuer. Individuals who meet either one of the following two criteria: have a net worth of at least $1 million, excluding their primary residence, or have gross annual income of at least $200,000, or $300,000 combined with a spouse, for each of the past 2 years, with the anticipation that this level of income will continue. Institutional investors. Institutional investors are typically large entities that pool their money to purchase securities. Institutional investors include banks, insurance companies, pension plans, endowments, and hedge funds. The SEC refers to certain institutions as qualified institutional buyers, QIBs. However, to be considered QIBs, the buyers must satisfy the following three-part test. 1. Only certain types of investors are eligible, including insurance companies, registered investment companies, registered investment advisors, small business development companies, private and public pension plans, certain bank trust funds, corporations, partnerships, business trusts, and certain non-profit organizations such as insurance companies, certain bank trust funds, corporations, business trusts, registered investment companies, small business development companies, registered investment advisors, private and public pension plans, partnerships, and certain non-profit organizations too. The buyer must be purchasing for its own account or for the account of another QIB. 3. The buyer must own and invest at least $100 million of securities of issuers that are not affiliated with the buyer. Under no circumstances is an individual, even one who meets the standard of being an accredited individual investor, considered to be a QIB. Remember, QIBs are not humans, they're entities, for example, firms. By specifically defining both institutional and non-institutional retail investors, securities regulators are able to create rules that are applicable to only one type of investor. Give us your quick feedback before we proceed. How are we doing? Are you gaining value from this information? Let us know by liking the video and subscribing to our channel. Thanks. Now let's continue. The market structure. The way that the securities market is structured involves the issuance of the securities in one market, the primary market, and the trading of the securities in another market, the secondary market. Primary market. Let's start with the premise that a new startup company needs money for its expansion goals and will be issuing shares of its stock. Since the company is unaware of the nuances of raising capital, it works with the investment banking department of a brokerage firm. The investment banker will assume the role of the underwriter by agreeing, for a fee, to market the shares to the ultimate investors. These investors could include insurance companies, investment companies, pension funds, as well as individuals throughout the country. As the securities are sold to investors, most or all of the proceeds received will go to the issuer. Since this issuance marks the beginning of the share's existence, this is referred to as the primary market. The primary market is regulated by the SEC under the Securities Act of 1933. The secondary market. After the primary distribution of the issuer's shares, the investors that purchased the shares from the issuer will inevitably want to sell them. The market that brings together these buyers and sellers is referred to as the secondary market. In the secondary market, the funds are no longer directed to the issuer. Instead, the securities and the funds pass between investors. Let's examine some of the markets in which these securities trade. The exchange market. Traditionally, stock markets were broken down into two categories: physical trading venues such as the NYSE and over-the-counter OTC marketplaces. Exchanges offer a centralized trading venue that functions as an open outcry auction market. The auctioneer who controls trading in a given stock is referred to as a designated market maker, DMM. Over time, many modern exchanges began to shift to hybrid trading methodologies in which trading would occur on a face-to-face basis on a physical floor as well as through electronic linkages. Today, the distinction between physical and electronic markets is less important since many stock exchanges have eliminated their physical trading floors. NASDAQ, which is one of the world's largest stock markets, has always been an electronic trading venue, but is still classified by the regulators as an exchange. Any equity securities that meet the standards for trading on a national exchange, for example NYSE and NASDAQ, are referred to as listed securities. The National Association of Securities Dealers Automated Quotation System, NASDAQ, is perhaps the most recognized equity dealer-to-dealer network, described below. Although it wasn't always the case, the SEC classifies NASDAQ as a securities exchange. The NASDAQ system provides quotes on select securities that have been properly registered and meet specific listing criteria, such as aggregate issuer assets, the number of shareholders, and the number of outstanding shares. Dealer-to-dealer market. When stocks don't qualify for listing on either a physical or electronic exchange, they're considered to be trading over the counter, OTC, and the stocks are referred to as OTC equities or unlisted securities. In OTC markets, trades occur in non-physical dealer-to-dealer networks that connect participants through phones or, more likely, computers. Two networks which provide dealers with quotes on these securities are the OTC Bulletin Board, OTCBB, or the Pink Marketplace, a platform that was created by the OTC Markets Group. Neither the OTCBB nor the Pink Marketplace are registered as exchanges with the SEC and typically don't have the same level of trading activity as the NYSE and NASDAQ. Non-equities. Unlike equity securities, corporate, municipal, and U.S. government bonds don't have organized exchanges. Although some corporate bonds, for example convertible bonds, can be bought and sold on certain stock exchanges, most bonds are traded in the OTC market through various dealer-to-dealer networks. OTC equities or unlisted securities are stocks that are not listed on any physical or electronic exchange. They are traded over the counter, OTC, through non-physical networks of dealers who communicate by phone or computer. Two platforms that provide quotes for these securities are the OTC Bulletin Board, OTCBB, and the Pink Marketplace, which are operated by the OTC Markets Group. These platforms are not registered as exchanges with the SEC and usually have less trading activity than the NYSE and NASDAQ. Bonds are another type of non-equity securities that are mostly traded in the OTC market. Corporate, municipal, and U.S. government bonds do not have organized exchanges where they can be bought and sold. Some corporate bonds, such as convertible bonds, can be traded on certain stock exchanges, but most bonds are traded through dealer-to-dealer networks in the OTC market. OTC equities or unlisted securities are stocks that are not listed on any exchange. They are traded over the counter, OTC, through networks of dealers who use phone or computer. Two platforms for these securities are the OTC Bulletin Board, OTCBB, and the Pink Marketplace, which are not registered as exchanges and have less trading than the NYSE and NASDAQ. Bonds are non-equity securities that are mostly traded in the OTC market. Corporate, municipal, and U.S. government bonds do not have organized exchanges. Some corporate bonds can be traded on some stock exchanges, but most bonds are traded through dealer-to-dealer networks in the OTC market. OTC equities or unlisted securities are stocks that are not listed on any exchange. They are traded over the counter, OTC, through networks of dealers who use phone or computer. Two platforms for these securities are the OTC Bulletin Board, OTCBB, and the Pink Marketplace, which are not registered as exchanges and have less trading than the NYSE and NASDAQ. Bonds are non-equity securities that are mostly traded in the OTC market. Corporate, municipal, and U.S. government bonds do not have organized exchanges. Some corporate bonds can be traded on some stock exchanges, but most bonds are traded through dealer-to-dealer networks in the OTC market. Other execution methods and venues. In recent years, market participants have created alternatives to the NYSE and NASDAQ for trading listed securities. Many broker-dealers have abandoned their market-making operations on the traditional exchanges and directed orders to high-frequency trading firms. Other broker-dealers have found alternative trading venues which compete with the NYSE and NASDAQ for trading volume. The third market. Electronic internet-based trading doesn't require that orders be sent to the physical trading floor because alternative markets have emerged. The third market refers to exchange-listed securities being traded over the counter or away from traditional exchanges. While some of the trading in listed stocks still occurs on their primary exchanges, third market volume has grown in the last several years. In a manner that's similar to traditional exchanges, the third market brings together investors and also accommodates after-hours trading. The fourth market. The fourth market refers to direct institution-to-institution trading and doesn't involve the public markets or exchanges. While some of this trading involves different portfolio managers contacting one another by phone, most true fourth market trades are internal crosses set up by broker-dealers that execute trades for institutional accounts. These proprietary trading systems, PTSs, are established to facilitate the institution-to-institution trading are often considered a part of the fourth market. Essentially, the third market involves transactions between dealer brokers and large institutions, while the fourth market only involves transactions between large institutions. The activities of these markets have little or no influence on the workings of the typical stock trading by an average investor. Electronic communication networks, ECNs. ECNs are market centers, that is exchanges, that allow for both the quoting and trading of exchange-listed securities. The objective of an ECN is to provide an electronic system for bringing buyers and sellers together, matching. These systems allow subscribers to disseminate information about orders, execute transactions both during the trading day and after hours, and buy and sell anonymously. ECNs charge subscribers a fee for using their systems and act in only an agency, broker, capacity. Dark pools. A dark pool is a system that provides liquidity for large institutional investors and high-frequency traders. But it doesn't disseminate quotes. The name is derived from the fact that the details of the quotes are concealed from the public. The system may be operated by broker-dealers or exchanges, and it allows these specific investors to buy and sell large blocks of stock anonymously. The objective is to allow these investors to trade with the least amount of market impact and with low transaction costs. Some dark pools provide order matching systems and may also allow participants to negotiate prices. As we end this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but a huge support for us, and it is completely free. To be among the first to be notified of the continuation to ace the SIE exam, please turn on your notification. Thanks.